Ladies and gentlemen of the remaining crypto space, we're live on a Monday, September 19th at 11:52 a.m. So it's a good topic for today. Obviously, yesterday, Sunday, markets retreated significantly. It's not like that was unexpected. Is it expected for markets to significantly pivot and start to appreciate? Where's the capital coming from? And that's why the topic today is liquidity and how we look at it, how we view it, what is it, how do we understand it, what are the implications of it, what does it mean? How do we take action based on the data that we're looking at to try and understand what the hell the markets are doing? Market liquidity versus portfolio expectations. So expectations as well as management. How do you manage a portfolio in these conditions? And what are the expectations of that managed capital? That's what I like to think about. So the expectation really needs to be either highly protective, and you've successfully protected a fair amount of capital, which is really dollars. Dollars have been extremely outperforming the entire market. Their value has been going up significantly. The value of the dollar, people think of it as a unit of account. Sure, it is from an accounting standpoint, but the value of the dollar, the purchasing power of the dollar, has been significantly appreciating relative to risk assets. Now, clearly, it has depreciated significantly relative to consumer staples and other things, which introduces a great complexity in trying to understand what the hell is going on. But we're mostly interested in assets, risk assets in this case, because we're talking about the crypto space, because we're not really having a portfolio of Subway sandwiches and wheat and grain, like, commodities traders do things like that, but they're not really taking hold of it. I guess the big players are putting that stuff in warehouses, and that's a big trade. And they've outperformed the market because those things went up significantly, but now everything is rolling over. That's why I have Lynn up, because she understands it probably better than anyone. Fed is going to tighten until something breaks, and it'll either be the treasury markets or credit markets. And then they have to step in to do something, because if you have no credit, you have no economy, and if you have no treasuries, you have no collateral for an economy. So what is that? April to September 25th, basically. May, June, July, August, September. So that's 5 months in the making. She retweeted it. And back in April, PMI rolled over. And I would imagine, I don't have the chart up, Raul looks at those charts, probably the best. And he thinks of it as the core of where the markets are heading, and they're on the decline. Everything has rolled over ferociously. Even Biden was saying 0.1% inflation month over month. Now, people think in terms of, oh, the inflation's 8.4%. It's 8.4% for the year. Everything has gone up in price. Consumer staples and whatever the hell the CPI measures has gone up 8.4% for the year. That number's not going to go down. For that to go down, you'd have to have negative 2% CPI. And if the negative CPI print, it's going to be a catastrophe. So that year over year number doesn't go up, but if you have 0.1% per month for 12 months, come on, there's 1.2%. That's 1.2%, and that's well below the Fed target. So the Fed probably doesn't want to see 0.1% CPI month over month. See what I'm saying there? So we've rolled over, and that doesn't mean much with regard to what we do with the portfolio. That just means they're probably making some serious decisions right now. It's certainly a very complicated game they play. And I wouldn't go as far as saying that everyone says they're idiots, they don't know what they're doing. I think they have a very tough game, and they really don't speak it well, how difficult their choices are. And it's very critical because they're playing with human lives and us and what we do and our money, and that's everything. That's social stability. Um, So Lynn hit it very well. And the point of the stream is liquidity and how to view it. And Arthur gave us this great breakdown of how he looks at liquidity. And liquidity significantly was drained from the market. Liquidity is not going up. So when the liquidity is drained, I've said and I will say that it is a negative sum game. There is less currency units that the same amount of people are chasing after. So that doesn't work out well. That means it's a very hostile environment. It's an adversarial environment. It's basically mine. It's a mine type of environment. And that means it's the people are out to get for themselves and take from others, and that's basically what capital gains is. Except during a bullish market, people are able to take capital gains, but there's more liquidity coming in, which allows the price to go up over time, and that's the traditional staircase pattern that everyone knows about. Um, but this is not that market, so clearly you can play things to the downside, and that's why GMX has been so hot because you're able to do technical analysis, you're able to play capital gains to the downside, and that is a historic way that everyone engages with the markets. Obviously, over the last 2 years, we've talked about a different way of engaging with the markets, more of a Warren Buffett type of mentality, the ownership of enterprise, the attaching yourself to their cash flow, and that is not the same thing as capital gains. And had some nice conversation this morning on Discord about thinking on what that all means. Do you engage with capital gains to the point where you have enough capital that you can passively engage with the market? And I would like to remind everyone that crypto and risk assets and appreciation, especially since 2008, has made it seem like this is a great way to make money. It is the same as it always was. Capital gains, it's always been an adversarial game, and it's very difficult, and it is not easy, and you don't need to do that. Historically, people worked, they saved, they invested, and the investment produces a rate of return, and traditionally you could do that with banking. Can't do that anymore with banking. You could do that with REITs, but it's pretty marginal amount of cash flow that they surface to you. You could do that with crypto. There's a lot of cash flow that surface here, but they're very volatile on the principal pricing. Um, and that's what you're investing in when we talk about my current way of engaging with the market. You're investing in enterprise that surfaces cash flow. How much of that cash flow? How much is their stock issuance diluted? What kind of so if they're making $1 million, but there's only 10 shares, clearly those 10 shares are getting a shitload of cash flow. So the reason why equities and REITs get such marginal cash flow is because they've been diluted for purposes of capital raise. So the same exact analysis can be done with tokens. How many tokens have been emitted? What percentage of the cash flow is each token receiving, which is nice when you break it down from like a VE curve or whatever token perspective. How many dollars, how much are you getting per token? Block token most of the time. And I think that's quite meaningful, and that allows us to compare what we're doing in the crypto space, or at least what I talk about that I do in the crypto space, as compared to the way we would have historically done it in equities land. Now, same type of analysis occurs. Uh, Price to earnings, P&E. What is the earnings per share? And we could, and what's most tantalizing to me about these crypto assets compared to equities and traditional corporations with human resources is there's no overhead in crypto assets. There's no debt. There's no real estate. There's no health insurance and benefits for employees because there is no employees. It's software that's automated, and that is what I find most interesting. So that's why I talk about things the way I do. And I obviously have engaged in capital gains activities over the years. We've talked about them on the stream. Buy low, sell high, trading, technical analysis, so on and so forth. So it's not that I discourage that behavior. This is not the market to engage in that behavior in unless you have acquired that skill set to achieve that edge. So this is clearly not a chart that's applicable for that, and curve certainly isn't a chart for technical analysis. And the volume isn't there. So for technical analysis and that type of strategy to be executed, you want trend formations, and you're not really getting high volatility, high volatile moving trend formations in this type of environment of decreasing liquidity. So you could always engage with that behavior to acquire more capital so that you can engage in passive market activity and produce more revenue. So that's how you make multiples using capital gains. But you really need those trend formations. You need that volume. You need that activity so that you can really see a setup. And that setup is the edge that you have over other actors that are just buying. They don't know why they're buying. But if you see an ascending triangle, you're like, oh, okay, and it hit it 3 times and it hit support 3 times, and boom, you're probably going to get a breakout. So you have the odds in your favor that you're going to get a breakout, and it rips 50% to the upside in the crypto space. That's the type of capital gains that you reap in the crypto space. You sell it, and then that's how you do that. But this is not a market where that is more likely than less to occur. Now you could do that to the downside, but you're probably not getting the trend formations to the downside either. And I'm not going to go through chart after chart. This isn't a TA channel, but you can find a descending triangle and short it, and that's why GMX has been so hot, because people have been playing the upside and the downside, and that's why these decentralized, perpetual swaps and options platforms are quite exciting, especially in the coming years, especially as the cycle of liquidity starts to flow in the other direction. So, right, we're literally in cycle one, more or less, and this is DeFi Llama showing us the amount of liquidity across basically the DeFi space. There's only $50 billion in the space. There's a tremendous amount of liquidity compared to December 2019. I think this chart is a little off because it probably includes protocol valuations. But in December 19, there was no liquidity. There was no churn of stable coins. It wasn't even Aave. It was Len back then. There was no um, uh, money creation process as per double entry accounting. There was no Aave as it is in its current form, cross multiple chains, integrated into centralized exchanges. There's such wonderful Alt L1 and L2 integration on centralized exchanges now, so there's liquidity flowing in from that source. But the liquidity has clearly flowed out significantly, and that entails there's going to be less opportunity for very robust and well-structured trend formations. So that means the capital gains are hard. I would say in this environment, I don't even give a shit about capital gains. I just, you wait, you sit. But obviously, I'm speaking from my perspective, having engaged in the activity I've engaged in, to be able to structure the portfolio as I've structured it currently, that I can't sit back and just wait. Now, clearly, we're all significantly down from all-time high total portfolio valuation, but that's okay. That's expected. This is all cycles. It all goes in cycles. And at this point in the cycle, I'd sit back. And if you don't have enough capital to engage in a passive portfolio management strategy, then don't, then wait. But I like to remind everyone that you don't need to chase capital gains ferociously. You don't need to try and make a fortune, and you don't need to make money that way. You can engage with markets, especially the crypto markets, in a traditional passive portfolio management strategy. Before 2008, and I don't know, I haven't looked at the demographics and what the age group of people that watch me, but I doubt there's many 40 to 60-year-olds that have spent a decade, 2 decades saving and accumulating and allocating to bonds that are producing 2, 3, 4, 5, 6, 10%, whatever decade in the 70s, or REITs 2, 3, 4, 5, 6%, and accumulating interest-bearing assets. But you could do what I talk about with smaller portfolios and save for retirement. It takes 20 years, 30 years, but that's not, historically speaking, an outrageous statement to make. It used to be, and it pretty much still is, you have to save and work for 10, 20, 30, 40 years to retire at 65. So you can start and you're accumulating yield bearing assets that are representative of an actual enterprise. You're assessing price to earnings. You're trying to get a P&E of 1. That's what Buffett always said. If you find something with a P&E of 1 and they actually have potential earnings growth, then you're getting your discount on your cash productive enterprise. So that's all these protocols are. All of this is just enterprise, digital enterprise that has no infrastructure, no healthcare costs, no human resource costs, no debt burden. There's no debt burden. That's crazy. When you're going through REITs and you're going through equities, you're seeing their balance sheet and they're loaded with debt. And that's a burden. That's not the case with these assets. There is no real estate cost. There is no DevOps cost. There's no server infrastructure cost. Ah. So this is the holy grail of everything that Buffett does, except he doesn't understand it. He doesn't see the relationship, or he doesn't see these assets as a traditional enterprise, just a digital enterprise. And that's why I talk so passionately about this perspective, because it's just something that he doesn't see. But this is exactly the, the holy grail of everything that he has done as an investor. Zero debt. Zero debt. And the cash flow is surface. The cash flow is passed through. It's just wild to me. Who's in the house today? We got Zoidberg in the house. Alan, good morning. I like the idea of owning the base VE curve asset, but do you think convex is better for small actors versus VE curve of the price Ethereum increase was made? Well, see, that's a calculation, and you have to assess what's the do- it's a very complicated equation, obviously. And it's not something for me to answer because, in many regards, it's subjective. For many regards, it's a speculative bet. Tetranode has typically favored convex level because he thinks the incentivized voting is uncapped. I favor base level because I think it's not the bribes that are the biggest thing. I think it's the transaction fees. And if you're doing, if Curve's doing 50 billion a day, 100 billion a day, or whatever the hell it's doing in 5, 10 years, to me, that's the most tantalizing thing. And if Curve is diluted 100% and VE Curve's diluted 100%, you get your voting power cut in half, and it's $100 billion a day in transaction fees. Okay, I'm not too worried about that kind of dilution. So to me, I favor the base level. Now, I don't favor the base level for like an aura balancer situation, but they're a little nascent. I can't really assess where it's heading right now. But that was very much the case with Curve when it launched. It was an absolute tragedy when it launched. Clearly, VE Bow is not very productive as compared to VL Aura. And it's not like I'm taking positions in any of this shit. Maybe if there's a significant discount on Aura, because it's still quite productive. I'm quite surprised at how productive Aura has remained. It's at about 10 cents per vote this week on Hidden Hand. Let's take a look at Aura and see what it's doing. It would need to still come down significantly for me. Considering the amount of cash that I have on hand, I can't see myself taking a position here. I would need it still cheaper. Um, and if it doesn't hit that price point, that's okay. It's not meant to be. Either I get the discount I want or I'm not going to take it. I really want to see a buck. Cut it in half, a buck 10. A buck 10 and I'm going to get tempted. And I could probably double up on VL Aura. And now the speculative bet there is if it remains as productive as it has been. 10 cents per vote locked Aura is quite productive, and it's been quite consistent. If you look at the last three, we're literally at round 7. It's barely off the ground. So it's very hard to get a sense because we have no history to go on about the directionality. So the same thing can be said even about curve and convex. Um, it's very, very new software. If you look at the history for curve on the monthly, this thing basically launched. There's basically no history to go on. If you look at convex, it's an even shorter chart. I mean, look, it looks horrible from a Binance perspective. Is this Binance? Yeah. It's basically straight down on Binance, but it had a history in 2020, 2021, I believe, obviously. But this is the burden of what we do, Alan. Is do we do one thing or another? Is it something better for a smaller actor or a larger actor? I don't have the answers for that. What matters most is, do you have enough cash to cover monthly expenses for a period of time? Do you have worst case scenario covered? That is how I live my life. If I can cover worst case scenario, I'm able to sleep at night. As for what's going to outperform, I don't know what's going to outperform. Split it in half. But that's not a recommendation because I have no idea what the heck the market's going to do. But these are the conversations I have with myself to try and make these types of decisions. Um, for myself, I'm probably leaning towards just no further concentration in the Curve ecosystem. I'm probably going to liquidate my convex position when its vote lock is complete. I'll probably free up available liquidity for the time being. I'll assess the markets then. So I have a month. October 19th is when I could exit my convex position. And I'll just wait. As for what kind of opportunities are available, we'll have to see the price points. If we see, the buck 10 price point, give or take on Aura, that'll probably be interesting to me. Um, I don't love to talk about things that I may be interested in purchasing. I know that's what everyone wants to hear, and I know that's what YouTube is known for. Oh, this is hot. This is going to be great, and getting suggestions and recommendations. And that's why I focus so much of my content on the concepts and the conversation and the ideas and the narratives. And that helps other people make these very complicated decisions for themselves. Um, I'm into, I think HXRO is going to be hot. Um, Now, that's my opinion. Clearly, it's not even launched yet, so I don't know what that means. The chart is interesting. And I don't like saying things like that, but this is probably the only thing I've done over the last several months, for what it's worth. Um, but I guess people take value in what I think. I don't. This is certainly not an encouragement nor a discouragement. This entire market is a zero-sum game, and if someone can capitalize and take your money, they're going to do it. So that's why it is so hard to buy fear. They say buy fear, sell greed. Yeah, okay. That's so not easy to do. You're literally buying, when you're buying fear, you're buying into an illiquid market that you're hoping becomes liquid. And where does that liquidity come from? At this point, it really comes from the Fed. This number here on DeFi Llama, 53 bills, not going to start going up until this number starts going up, until the complexity with Japan starts turning around. I mean, that's literally, they're on the ropes right now. And what the hell is going to happen with Europe this winter? The winter hasn't even started. And everything's changing. And that's why we talk macro so much, to try and understand this chart, the liquidity, and the pressures that are being placed on monetary policy and fiscal policy by geopolitical events. And it's all connected. That's why we've started talking about macroeconomics in the context of the cryptocurrency space, because it's all related. I hope that helps. I don't. Clearly, it's not a specific answer, Alan, but do the best I can. Lord of the Pine Cones in the house, a pleasure. Malik, there's no soft landing. Break the market or let the market drive liquidity. So that's basically what the bond market's saying. The bond market's on the ropes. And this is This is Luke Groman's territory, is when does the market dictate really what they can do from a monetary policy perspective, and what can the market force from a fiscal policy perspective? Because at some point, if the market breaks, they can't raise rates because the market's fucking broken, and they're going to have to step in to literally prevent the market from imploding in on itself, which will devolve into social anarchy. So that's the type of conversation. You only understand that shit when you look at macroeconomics. So I implore patience. I deploy patience. I encourage patience, and certainly not trading and capital gains in this type of market unless you're quick trigger. And if you're quick trigger, you're probably not following me in the first place. So I think it's prudent and very reasonable to recommend that type of not engaging in that kind of behavior in this kind of market. Gaffer's in the house. One curious view, a pleasure. Brian, pleasure. Lewis is in the house. Hello, my friend. Hope everything's well. Are there any new projects with decent monetary policies and income stream potential that have your attention? Generally speaking, no. Albeit I didn't mention HXRO. But it's illiquid. There's no trading. It's off the radar. So to me, that's actually quite interesting. There's no drawdown yesterday at all. Um, it's on Solana. You can buy it on Ethereum, but eventually, to participate in staking, it's on Solana. And this is what's my rationale here is that you lock your tokens and you're going to gain 50% of the revenue stream. That's based on the documentation. And USDC collateral for market interaction or market activity starts soon. I would imagine between now and maybe first half of October. And the speculation for myself is, GMX, an early off the radar GMX. It has a higher low. It's at a resistance level. There's no volume. It's off the radar. It's all small. I don't even know what they're trading here. If there's no liquidity, that's certainly not trading. So that's my sentiment here. It would be there's 1.3 billion dollars worth of liquidity on Solana, 1.28 compared to Arbitrum, which has 931 million. So there's literally more liquidity on Solana than Arbitrum, and GMX has done what it has done thus far. So that's the speculative conversation I have with myself in this regard. That's the only thing really that has stood out to me significantly, all things considered. It's hard to take a speculative position in market conditions like this, but it was enough for me. The chart, the narrative, the cash flow, Arbitrum versus Solana, the size of GMX, and that's a couple of words that highlight the conversation that led me to take a position. Hope that helps, Lewis. That's about it. Otherwise, portfolio is set. The portfolio is not being adjusted until October 19th. I'll probably get rid of the convex position because I have overexposure, because I have the curve position. I don't need overexposure to the curve narrative. And I say that with regard to a several year time horizon. In 2, 3, 4 years, do I really need all that redundant exposure to the curve narrative? I don't. So I overexpose because convex has done what it's done, but it doesn't mean I necessarily need such exposure. Pepe, do you have any short-term 1 to 10% bets at the moment? Yeah, probably the only one is HXRO, but it's not 1 to 10%. I don't want. No, I do. So to answer your question, I don't have any 10x bets at the moment. There's no 10x's to be expected in this kind of market. There's no liquidity in the market. The liquidity has been completely drained. So I know that's a very boring answer and a disappointing answer, but it's clearly an answer that Bitcoin won't give you. There is no opportunity in this market unless you are a cutthroat trader, or unless you have capital to throw around and you get in 20 to 30% on a quick mill that you throw over here, and you're doing market making. There's risks associated with market making, but you could You're making a lot of money, market making high activity, highly traded assets. You make the biggest money with market making when the capital, the price point trades in a particular range. And you can enter a market making position with just stable coins if it dips down and then back up. So you captured all of that volatility to the downside. You can enter a single sided Uniswap V3 market making position with just USDC. It dips down, it's buying on the way down and it's selling on the way up, and you're capturing all the trading fees in between. So market making and Uniswap V3 is not the most uninteresting way to engage with a market like this, because technically we expect things to go down and then go back up. Now bear in mind, as things go down, you're going to be buying on the way down. The value of the LP position is going to be depreciating on the way down, but you're capturing the trading fees. Then the price is going to go up. The value of the LP position is going to go up, but you've captured all the trading fees. And then by the time you get back to the top of your range, you're all stable coins again. So you got in and you got out automatically via the Uniswap V3 market making position. So that is something to consider, but that's not going to do a 10x. So that's not going to do a 10x Pepe, but you're gonna capture revenue, and that is interesting to say the least. One curious view: do you think that strategy, passive approach, will hold if inflation continues to spiral over the medium term? Well, passive is just historical. There's two ways to engage with the market: adversarial and capital gains, trading, technical analysis, so on and so forth, or passive, Warren Buffett, purchasing enterprise at a discount optimally that gives you cash flow that pays you because you own the business. So yes, the strategy uh, is inarguably a valid strategy under all market conditions. Tony, Noah, my man, do you ever see a bull run based on proof of work, UTXO, crypto? No, not. No, it's completely off the radar. Everything related to UTXO is completely off the radar, especially with the emergence of the financial structures in DeFi over the last years. There's UTXO is literally just capital gains, and it's speculative. They don't offer any incentive systems. There's no reason to buy a UTXO token. You don't. What are you buying Bitcoin for? It's not paying you. The only reason you're buying Bitcoin is you hope other people buy it after you, so you could sell it and take the appreciated price. So you're taking money from the people that bought it after you. And with UTXO assets, that's it. It's just an asset. There is no scarcity. Even Bitcoin is inflationary. I don't. That I will say that over and over again. Bitcoin is inflationary. It is a disinflationary asset only every 4 years. And by the time that Bitcoin has no inflation, every single person on the stream is dead. It will not. There will be no inflation of Bitcoin in what, 2140? We're all dead. So how the hell are you going to engage in the market thinking like that? So there's literally, you get nothing for owning UTXO assets. There's no incentive systems. There's no enterprise. There's nothing. So that's why this market since late 2019 has been so extraordinary as compared to 16 and 17, and obviously the earlier cycle. There was none of this. There was no financial activity. There was no incentive systems in 16 and 17. All there was adversarial activity. Completely different market. Wild world. Um, Tape pushers in the house, Beckman. Previously, well done. What's your time frame for HXRO? Sometimes your time frame surprised me. Um, Time frame. I expect. I have a long time frame on it, but I have actually short-term appreciation expectation. I think it's completely off the radar. I don't think anyone is even paying attention to it, and I just see GMX written all over it, and I see more liquidity on Solana versus Arbitrum. So I actually have a short time frame. That's what I see. That's what I feel. I feel it could be one of the few things that I've allocated to in the short term that could be appreciated by other people other than myself. Not financial appreciation, but me actually appreciating the asset. I appreciate it because of what they're building and what it will do and how it compares to GMX and how the network Solana compares to Arbitrum with regard to the amount of liquidity that's on it. So it's appreciated by me. So to add on that, when Berachain launches early next year and Hidden Hand is going to bribe on the base layer, Berachain will use proof of liquidity, which is a curve-like system on the base layer. Okay, when it launches, we'll analyze, and as it approaches, and I do not get excited about the future too much. I get excited about an opportunity that I see that I can engage in, and then you do your risk analysis. What kind of risk am I taking now? Um, and that's just something that so many folks in the market just completely ignore, especially like traditional UTXO assets, especially Bitcoin. They're buying it, expecting it to go up in price, but they don't understand liquidity. They don't understand macroeconomic liquidity, and they don't understand what drives people to deploy capital to the asset. And they're like, it's going down. It's not about it's going up in price, it's going down in price. It's why it's going up in price and why it's going down in price. And that's why this stream is titled Liquidity. That's what it's all about. Mi'kmaq and Doc say HXRO is in ERC20, so they deployed it there, but bridge to Solana. Yeah, like back in the day, like when they started building the protocol. Um, I remember back in like early 2020, we would talk about protocols that would create their ERC20 as a placeholder, and they were deploying on various Alt L1s, and we were like, they don't even have an ERC, they don't even have a native token. Um, so this is the situation for the Ethereum ERC20 for HXRO, but they have a strategy and it's on um, Solana in the form of the wormhole wrap version. So how they're going to handle tokenomics and pivot to a native implementation, the was it SLP, whatever there's the native version of the Solana version of the ERC20 implementation. That's they'll come up with that, but it's not a mainnet. It's not an Ethereum mainnet implementation. The protocol is a Solana product, which gives me once again the feel of GMX. You can't really do this type of stuff on mainnet. The transactions are even at 15 Gwei, $2, $3, $4 a transaction. When stuff's a penny, it changes the volume and the activity to such an incredible degree, as we've seen with GMX. Mix is in the house. What does it take to excite the cap? Oh, when I see liquidity, if I saw liquidity actually flow into the system rather than completely being drained, uh, we see uh, we see liquidity go up. I would love to see liquidity go up. I would love to see a capital gains opportunity. I would love to see a wonderful ascending triangle trend formation with increasing volume, with increasing market activity, and right now that doesn't exist. So I'm excited about this market for very different reasons as most would think. I'm excited because of how we can engage with the market in a passive way now, as compared to historically speaking. You don't have to do things in the market, but now we're thinking about a strategy and how we can engage in the market, this market, the crypto market, going into the future in a passive way. You can never do that historically. You know what excites me? Looking at this chart and seeing $53.3 billion worth of liquidity in the DeFi space. This didn't exist in December 2019, so that excites me. That's crazy. That is an emerging market. This market has captured liquidity, and that means we could talk about the crypto space as compared to a sovereign nation. That's crazy. That excites me. Raul, via what bridge did you transfer funds to Solana? Wormhole. Wormhole. Or you could use FTX. Encoder, greetings from Portugal. Nice live. It's very much a pleasure. Portugal. Wow, gorgeous country. Complex across the ocean over there, but nonetheless, well, Goodness gracious, what a gorgeous country. Mick, what's your equivalent of the DXY for the euro? I'm trying to measure euro performance, but not sure what to measure against. So it's all pairs. We'll end on this note, guys, but let's pull up the DXY. The DXY is predominantly euro and yen, but you could obviously break it down. Dollar versus. As you can see, it has a very similar chart presentation as compared to the DXY because the DXY is predominantly euro yen. USD JPY. And this catastrophe, because this clearly broke out significantly to the upside, 143. Wow, what an absolute catastrophe for Japan from a currency perspective. They got to figure something out because if this breaks, that's crazy. There's nothing until 160, and then you're in literally sovereign crisis territory. And the fact that this is an inverse head and shoulders is just wild. An inverse head and shoulders that broke out to the upside. Oh, yeah. All right. So that's where we are in macroeconomic conditions. We're waiting to figure out what happens with uh, Japanese currency. To understand the crypto market, you have to understand what's going on with Japanese currency. Why? Because if Japan's currency keeps weakening, they're going to sell their U.S. treasuries in order to buy Japanese yen to reduce this chart, to drive it down. But that in turn brings you over to charts like this, the 10-year. So they're going to sell U.S. treasuries. This is going to drive up yields. And now we're in U.S. sovereign debt crisis territory. So this is why the narrative that Luke Roman talks about is so prescient. Literally, like right now, it's ongoing, and that's why his narrative's so hot. Japan could literally crush U.S. treasuries, and then China could do it too. They have the most treasuries in sovereign reserve. And then I'm waiting for the middle of November for the OTC derivative stats. Check this one out, and then we'll wrap it up for today. Out? Yeah. So this is what is most concerning to me from a global perspective. It's the disinflation of leverage on U.S. securities. There's $598 trillion worth of OTC derivatives, which is basically a leverage position using sovereign debt, and it's lower. It's lower than 2008. It's never recovered. There's no inflation. There's no growth. So if they go risk off, and this is lower in November of 2022, that puts pressure on U.S. securities to the downside. There's less buy pressure. There's sell pressure. If they deleveraged, that means they're selling U.S. debt. And if they're selling U.S. debt, that means this chart goes up. And if this chart goes up 5%, how the hell is the U.S. going to pay interest on 5%? Especially if we head into a recession and tax receipts start to come down. If they're not, it's just a corporation. That's all government is. They take in a certain amount of money and they have to pay interest on this debt. And if the interest rate keeps going up, they're not going to be able to pay interest on the debt. And as it stands, the U.S. can't pay interest on the debt. They have to sell treasuries every year in order to finance government operations. So if everyone's selling treasuries around the world, how the hell is the U.S. going to issue treasuries to finance deficit spending if no one's buying the treasuries? Who the hell is going to buy them? It's the Fed that's going to buy them, but then it's an absolute catastrophe because if the Fed's buying everything, now it's a completely rigged game. Who the hell wants to buy something that's controlled by the government itself? And now that's yield curve control, basically. And that's going to take a hit right to the DXY, to the downside. And now you're heading down the road to the loss of faith in this financial system that the U.S. created. But to say that's a long way down the road. You don't speculate on shit like that. But that's exactly why Russia's doing what they're doing. That's why they're organizing with China. And that's That's all this geopolitical shit that's going on. Look how we ended the stream. We talked about all this geopolitical macro shit, and we talked about all of it to try and understand what the heck is going on in the crypto space. It's all related. Let's wrap it up for today. I thank you all, as always, for joining. 40 people in the stream. Hey, not bad for a bear market. Monday, September 19th at 12:30, 7 p.m. As always, tell everyone to join. I can't help anyone if you can't join. After party on Discord for the most rational community in the entire crypto space. Today is only Monday. I will see you guys during the week. I wish you all a good one, and I will see you next time. Peace.